This one feels to me like a tired old bubble. I'd be shocked if the froth hadn't deflated fairly significantly within the next 2 years or so. Whoever coined the expression Magnificent Seven clearly didn't see the movie. 4 of the 7 are dead at the end of the movie. I think 5 or 6 of the 7 will have been gravely disappointing to investors 10 years hence. If those valuation spreads come in, that means either a slow fizzle or a bubble pops.
This episode of Monetary Matters is brought to you by VanEck's Semiconductor ETF, ticker SMH. As you may know, SMH is the largest semiconductor ETF by AUM, with over $25 billion in assets under management. But what you might not know is that SMH has historically outperformed its largest competitor, SOXX. In addition to SMH, VanEck has launched SMHX, a first-to-market fabless semiconductor ETF that's been intelligently designed to capture low capex, high-margin chip designers, setting the next stage of AI. You'll hear more about both later in the show. Let's get into it. Today, I'm speaking to someone I've been wanting to interview for a long time. Very pleased to welcome to Monetary Matters, Rob Arnott, founding chair of Research Affiliates. Rob, good to see you. Welcome.
Thank you very much. It's a privilege to be on your podcast.
Rob, this bull market we've been having for close to 3 years now, how would you characterize it when you look at the data of the contribution in this bull market of just how narrow it is, as well as the earnings growth? What do you see?
I see a lot of things in the current bull market that are very reminiscent of 1999 and 2000. I have recently taken to openly describing this as a bubble, with the caveat that it's not as extravagant a bubble as 2000, and the caveat that betting against bubbles is very dangerous. Bubbles will persist longer and go further than most of us can possibly imagine. The biggest bubble I've ever studied is the 2008 Zimbabwe stock market bubble. They were engaged in hyperinflation, in monetizing debt, and running the printing presses. And as they came into the summer of 2008, one could easily have looked at that and said, they've got hyperinflation. I don't want to own this market. I'm going to short sell this market. I'm going to take just 2% of my money and short this market I'll make 100 basis points easy. Roll the clock forward 6 weeks. The currency had fallen in value tenfold. The stock market had risen in value in domestic terms 500-fold, meaning that in US dollar terms it had risen 50-fold, meaning that you just bankrupted yourself. The next 8 weeks, the currency fell another 100-fold, and the stock market effectively went to zero and stopped trading. You would have been right, but bankrupt. Never bet against a bubble in the sense of overt shorting, because it can take you out. Classic short squeeze. And what happened in Zimbabwe, same thing that's happened in Venezuela, is when people don't trust their currency, they want real assets. Real assets can include property. There was 2 or 3 times in the last decade, there's been an extravagant bull market in Venezuelan real estate, taking property to extravagant prices, even in US dollar terms. And same thing was happening in Zimbabwe. And other real assets are stocks. Owning a business protects you from a currency that's going to zero. Now, it doesn't protect you all that well because the businesses have trouble running their business in a context of hyperinflation. But bottom line is, I look at this as kind of a slightly smaller repeat of the year 2000. I'm going to go into a little bit more detail. Mm-hmm. In the year 2000, bubbles form and grow based on a narrative. The narrative in 2000 was the internet's going to change everything. And these companies, the dominant players, are dominant players who have a moat. It's going to be very difficult for others to push them off their ledge. Uh, and this is going to happen fast. So that narrative was right in its core premises, wrong in the supposition that the leaders had a moat that would last for a decade or more. Competition finds ways around that. And wrong in the pace of adoption. The world of 2025 is radically different from the world of 2000. The world of 2005 was not. Human beings embrace change gradually and reluctantly. And so the wide adoption of the tools of the internet happened gradually. And disruptors get disrupted. If you look at the 10 most valuable tech stocks in the world in the year 2000, how many of them were ahead of the S&P by the year 2015? Zero. Not one. People will say, what about Amazon? What about Apple? Apple was flirting with bankruptcy in the year 2000. Steve Jobs had just come back and was in process of saving the company, but nobody knew if it would work. It wasn't even in the top 40. Excuse me, it was barely in the top 40. Amazon, the report Amazon.bomb had pointed out that a bookseller couldn't possibly be as big as the market was giving it credit for. And they were right, but it didn't stay a bookseller for long. And so Amazon found its way. But even so, in the decade of the 2000s, Amazon and Apple were not brilliant performers. You had to wait a while. And so I look at today's world and I see another narrative embraced to excess. And that narrative is AI will change everything. Now, anyone who has played around with ChatGPT or other AI tools knows that it's going to change everything. It's the real deal. It's going to have uh, intelligence rivaling the creativity of the human brain in my lifetime for sure. Well, unless I drop dead tomorrow, but in the next 10, 20 years, it's going to have human intelligence, and it's going to be very interesting how we interact with this intelligent, not quite life form. But be that as it may, it'll change everything. And the narrative is, once again, these companies have moats. They won't be disrupted, dislodged all that easily. The narrative is this is going to happen faster than you can imagine. And the reality is, almost certainly, it'll happen a little more gradually than the advocates of AI think. Perhaps a lot more gradually. By a lot more, I mean what they think will happen in 1 year happens in 5. What they think will happen in 3 years happens in 15. It'll still be, in the context of a human lifespan, it'll still feel incredibly fast. The other part, the notion of the moat that protects them, consider that people have, quite a while ago, I replaced Google as my search engine with Perplexity.ai. Perplexity is an AI of AIs. It chooses which AI engine is best suited to your question. It's really cool. Now, they're disrupting Google's core business model. Why? Because you ask a question of Perplexity, it gives you a textual answer that is succinct, on point, and mostly accurate. You have to be careful because there are still hallucinations, but they aren't nearly as bad as they used to be. And relevant, 3 to 6 relevant website links. All right, that's exactly what I want when I have a question. If I ask a question of Google, I get pop-up ads that are ostensibly relevant to my question that are selling me something, and sponsored websites. So I have to scroll down 5 or 10 entries before I get something useful. That is Google's core business model. They earn money from pop-ups and they earn money from sponsored sites. The AI successor to Google is displacing Google. Google has had to embrace AI as the central answer on its website uh, in order to disrupt themselves rather than getting disrupted. Meanwhile, OpenAI itself, creator of ChatGPT, was disrupted early this year by DeepSeek coming out of absolutely nowhere. ostensibly built on 1/100th the resources of OpenAI with materially slower chips than OpenAI uses, an order of magnitude slower. And it's ostensibly as powerful as ChatGPT 4.0. I say ostensibly because I don't know how you measure how powerful an AI is, but it's great. It's as easy to use as ChatGPT, except when you want to ask it questions about the CCP or about President Xi.
A key idea you mentioned, Rob, is that big bubbles form, they don't form over fads or technology that's not real. They actually form over technology that is going to be disruptive. They form over the
Absolutely.
real deal. Like the South Sea bubble, transatlantic, transpacific shipping was obviously a huge deal in the history of humanity, and that's why we had bubbles, the dot-com era and the like. Tell me the similarities and differences you see right now between AI and the dot-com bubble, particularly when it comes to where are the earnings coming from? How
Right.
does the growth in earnings and revenues, but mainly earnings, compare from the dot-com bubble to now?
Well, there's a myth that the dot-com bubble was anchored heavily on companies that didn't know how to make money. Simple fact is there were a lot of those. There's a lot of those today too. The big winners in the dot-com bubble did know how to make money. Microsoft was very, very profitable, and it was number one. Cisco was profitable, and so forth, and their profits were growing fast. Um, so it's not as different as people like to portray, but it is fair to say, let's take a look at fundamental index, the strategy we invented 20 years ago. RAFI is widely seen as a value strategy, and it is. It takes the growth stocks and says, okay, you're priced to reflect lofty expectations. Those expectations are probably true. If they're true, it's going to be a market performer anyway. So I'm going to reweight you down to your economic footprint. Value stocks trading at a deep discount. Yeah, you've got headwinds, you've got troubles. We know that. But that's in the price. And if it's in the price, it's not going to hurt us to top it up to its footprint. That gives you a stark value tilt and a rebalancing alpha. If the valuation multiples go up because the price goes up and the fundamentals don't, you're going to say, thank you for the gain. I'm going to trim it. And if it tanks and the fundamentals don't, you're going to say, thanks for the deep discount. I'm going to top it up. So you get a rebalancing engine and a value strategy. The value tilt is every bit as large as the conventional cap weighted value indexes. So RAFI in the US has the same value tilt on average as Russell value, but its performance is relentlessly higher. Now, if you look at RAFI today, the so-called Magnificent Seven, and yes, they are magnificent. The Magnificent Seven are priced to be about 34% of the S&P 500. They're priced to be about 18% of RAFI because they are big businesses. They're very successful. And so that is one difference. A closely related difference is a more troublesome one. Um, when I say troublesome, I mean the fact that the Magnificent Seven are highly profitable and are in fact very big, successful businesses is a positive if you want to bet on cap-weighted markets and if you want to bet on growth. These are good, solid companies that are truly path-breaking. Um, the downside is that the concentration in the market is without any historical precedent. The allocation to the five most valuable stocks in the country and in the world is just under 30% of the S&P 500. Where was it at the top of the dot-com bubble? 16%. We have almost twice the concentration that we had at the highly concentrated top of the dot-com bubble, which means these companies had better not be knocked off their perch. And the simple fact is that history is full of technological revolutions where pioneers and disruptors get disrupted by new pioneers. We've seen just two examples that I alluded to that are more or less this year, where people are dumping Google in favor of ChatGPT as their search engine, and in which ChatGPT is being dumped in favor of DeepSeek, that sort of thing. So the simple fact is, disruptors get disrupted, and change happens slower than people think. One anecdote that I think is relevant here: the chairman of Cisco Chambers in March of 2000 said, "I don't see any reason that Cisco's sales and profits can't grow 40% a year as far as the eye can see." Now, what is 40% growth? After 5 years, you're 6 times the size. That's a bunch. Where is Cisco today? It's 6 times the size that it was in 2000. It had 8% growth, not 40% growth. 8% growth is terrific. For a quarter century, wonderful. But it was priced to reflect those lofty expectations, with the result that to this day, Cisco has never exceeded its March 2000 peak price. Qualcomm's an even better example. Qualcomm was the biggest gain in 1999, was up 2,700% in a single year, the biggest gain worldwide. It entered 2000 at a valuation multiple of 280 times earnings. How's it done since then as a business? It has grown 60-fold. Its sales and its profits are up roughly 60-fold in the last quarter century. That is astonishing. And that's enough that the share price has exceeded the 2000 peak, but not exceeded S&P returns. So it's had returns 2/3 that of the S&P over the last quarter century, even though it's grown 60-fold. That's the issue with bubbles. You have Palantir, fantastic company, visionary leadership, and and yet it peaked at, I think it was 140 times trailing 12-month sales. Scott McNally in the dot-com bubble, testifying before Congress in the year 2002, I think it was, he was being challenged for, why did you sell a bunch of your stock at the top in 2000? What did you know? And his response was, we were trading at 10 times sales. How does a company deliver a shareholder's money back over, let's say, the next 10 years if you're priced at 10 times sales? Assuming a steady state, you're going to have to return 100% of revenues to your shareholders. You'll have to pay zero for cost of goods and services. You'll have to pay no taxes, and which is sort of illegal, I think he said. And that's simply not plausible. What were people thinking? So he basically said, I sold because 10 times sales makes no sense. Well, what does 100 times sales tell you? It tells you either that they're going to see 40% growth as far as the eye can see for a decade or more, or that they're a frothy bubble.
And where do you think we are now?
I think we're look, the outperformance of these companies has slowed drastically, and it's the opposite of bottom bouncing. It's kind of top bouncing. That's kind of dangerous, and so I would steer clear. Whoever coined the expression "Magnificent Seven" clearly didn't see the movie. 4 of the 7 are dead at the end of the movie. I don't want to pick which of the 4 is going to be dead 10 years from now. No, actually, I don't think any of them will be dead, but I think 5 or 6 of the 7 will have been gravely disappointing to investors 10 years hence.
So again, that point of it can work out for a company's cash flows. When you said Cisco grew 6 times, at first I said, well, I don't think Rob is right, because I thought you were referring to market cap or share price. And of course, there, as you said, the top hasn't been exceeded. You were referring to the economic reality, whether it's
Correct.
revenues or earnings. So the company actually did grow just so much.
Profits and sales grew 6-fold. They just took 25 years instead of 5 years.
Right. And I guess the valuation shrunk by more than the earnings and sales grew.
Exactly. It's now priced, I believe it's on Russell value.
Mm-hmm.
Yeah.
So maybe in 20 years, some of these growth darlings could be in a value index. And
I would venture to guess that within 10 years, at least 3 of the 7 will be trading as value stocks. It's not that long ago, Meta was a value stock. In Rafi, it was one of our biggest overweights in the PIMCO RAE strategies, which are, I think, to this day, the only active strategy in the world that anchors on fundamental index as the neutral weight. It was our number one holding. But it was our number one holding because people called us up and said, "Why is Meta your biggest holding?" Well, what happened was it fell by 3/4. We bought it, and it soared by 400%, taking it from a 1% position to a 5% position. And so it was our number one holding because it had soared. Meanwhile, RAE uses momentum as a component to help us avoid buying value traps on the way to zero and avoid selling newly growing names too quickly. And so the momentum component kept us in Meta well into the point where it was back to being a growth stock. And then eventually, as the momentum slowed, it was taken back out of the portfolio. So bubbles are predictable in some ways, but one has to be very patient. One of the things about being a contrarian investor is you're never going to pick the tops or bottoms exactly right. I love averaging into a bargain. I love gradually averaging out of a winner. And if you do that, you're going to miss the top, you're going to miss the bottom, and you will look and feel like an idiot for a while. If you're selling an NVIDIA on the way up, and every time you rebalance, you're selling a little bit. Roll the clock forward a few quarters and you start to look and feel like an absolute idiot. But that's the only way to assure that your peak overweight for a bargain happens near the low, and your peak underweight for a frothy name happens near the high.
Rob, in an article we'll definitely link to called AIboom.com bubble, seen this before, you do have the first chart, you show the return decomposition for NVIDIA from the end of 2022 until actually the end of 2024. And then likewise for Cisco during the .com bubble, the last 2 to 3 years of that bubble. And it is interesting. You do see a difference that with NVIDIA from 2022 until for a little bit less than a year, the growth in the share price was all in the PE ratio, aka the valuation was going up. I assume the trailing valuation, and then you see these bars of yellow showing that actually the earnings really delivered. And for Cisco, it shows that throughout the .com bubble, valuation expansion was always part of the story, and for much of the story was actually the dominant driver.
That's exactly right. Yeah, this is one of the things that I said at the beginning of our conversation, that it's one of the big differences between 2025 and 2000. The foundation of underlying fundamentals is much stronger than it was in the .com bubble. There's a myth that there was no foundation of underlying fundamentals in the .com bubble. People often use pets.com as the ridiculous poster child for that. But interestingly, pets.com's price to sales ratio never got anywhere near Palantir's. Pets.com is a funny story. I don't know why, other than the name. The name is what makes it a fun poster child. But the underlying fundamentals it had a peak value of 400 million. That's not exactly a stupendous value. That was less than 1,000th the value of Cisco and Microsoft at the time. But the company had no sales, was created early 99, had $100,000 of sales in the second quarter, had $1 million of sales in the third quarter, had $5 million of sales in the fourth quarter, and then went public. What were its profits on that $5 million? They were minus $40 million. Why? Because they spent $20 million to buy pets and pet products that they sold for $5 million. And There was no business. Anyone who bought that stock uh, didn't look at the prospectus and ask the question, what the hell is their business? So, of course, it's a poster child for idiocy. There will be ones poster children for idiocy this go around, of course. I'd have to do some serious digging to find which they are. But bottom line is, if it looks like a duck and quacks like a duck, it probably is a duck. This is a frothy market. And some of the stocks at the top of the roster are going to turn out to have been bubble stocks.
Hope you're enjoying today's episode. Semiconductors have driven decades of innovation, resulting in massive efficiency gains in the global economy and powering tech giants such as Google and Amazon. SMH by VanEck is a focused ETF that captures the whole semiconductor value chain, from top-tier designers like NVIDIA and Broadcom to foundries such as TSMC through the equipment makers and software developers. Its market cap weighted, concentrated approach has helped SMH outperform historically its closest peer. Go to vaneck.com/SMHJack to learn more. Building on the design and success of SMH, VanEck saw an opportunity and it launched a fabless semiconductor ETF, ticker SMHX. It gives investors targeted access to the high-margin, capital-light segment of the semiconductor market. The fund focuses on chip designers that outsource manufacturing and are driving AI optimizations and applications at the edge. Go to vaneck.com/SMHXJack to learn more. And now back to the interview. I'm glad you mentioned what you call a myth that the dot-com bubble stocks were all about eyeballs rather than revenues. I did believe that myth. But then you just said that Pets.com, they had revenues, but they didn't have earnings. I think the Magnificent Seven, with the exception of Tesla, there has been a very large growth in revenues and earnings, extremely concentrated in NVIDIA. And you might say that even without the AI tailwind, a lot of the Mag 7 earnings probably still would have been pretty decent. Maybe I don't know. But how are you analyzing the return on investment that the companies are seeing from investing in AI? Because I think a hallmark of the dot-com bubble was a return of a huge investment in in websites and capital expenditures that ultimately did not pay off or took a ridiculously long time to pay off and resulted in a lot of huge billions of dollars of losses in 2001, 2002, 2003. Do you think we're going to see some of that shortly, or maybe are we already starting to see that?
I think we're already seeing that. I mean, investment and R&D is positively correlated with company success, future success. CapEx is not, which is interesting, and most people don't realize that. In a capitalist economy, one of the beauties of capitalism is, in order to be successful, you have to have happy customers. You have to have customers who value your product considerably higher than the price of your product. If you don't, you will fail. It's a wonderful mechanism to make sure people, the invisible hand of the marketplace, people deliver what other people want. Now, NVIDIA has very happy customers. They have customers who line up and will pay whatever it takes to be first in line to get those super chips. They have dominant market share in super chips. Their customers don't necessarily have happy paying customers. ChatGPT is hugely successful AI engine. I don't know how profitable it is because it's either free or cheap depending which version you choose. And the other companies lining up for those super chips, whether it's Google or Meta or the whole spectrum of tech companies, the companies lining up for those super chips are still trying to figure out how to monetize those purchases, how to transform that compute power, that astounding compute power, into profits. And when I say astounding compute power, It is amazing. Our CEO, Chris Brightman, talks to AI for several hours every weekend. He studies its capabilities so that can learn what it's good at and what it's not good at. And he had a conversation with ChatGPT 4.5 a few about 3 months ago, in which he posed the question: how does AI fit in with the broad sweep of human evolution? Is AI a next generation in human evolution? And the response was succinct, clear, and astonishingly well reasoned. And if somebody told me it was written by a double PhD in anthropology and philosophy, I would have believed them. It basically said evolution used to take place over the course of millions and millions of years. And then came intelligence. And with the advent of intelligence, it accelerated. And then came industrial revolution, and it accelerated faster. It closed in a rather creepy way. It said one could view AI as the next evolution of humankind. Um, Perhaps humankind will be a distant memory sometime in the future. Perhaps humankind and AI will merge. And then the closing sentence was, the wonderful thing is we get to choose. And I read that and I thought, okay, who's we?
Yeah.
Uh, anyway, just viewed objectively without thinking in terms of the existential aspects. I thought it was just a magnificent illustration of how powerful it is. But like I said, it's the real deal. But in a capitalist economy, if you're not producing what people value, um, you're on a path to oblivion. And that's a very interesting issue with AI. How do you turn it into profits? One brief note is that there's a narrative out there that AI will radically accelerate productivity gains in the macroeconomy. And directionally, I think that view is right. It will improve productivity in a very meaningful way. I don't know that it'll happen fast enough or broadly enough across the macroeconomy to boost real per capita GDP growth from what seems to be a ceiling of about 2% in modern economies to 4%. Certainly not to the levels that would allow us to continue to run 6 or 8% deficits and not run into a financial crisis.
A pretty wonky question, but I'm talking to the right guy for it. You said that research and development is positively correlated with positive outcomes, but capital expenditure is not. I believe research and development comes from the income statement, whereas capital expenditure comes from the cash flow statement, obviously. And then the cash flow statement is that investment is then depreciated over time. One
Correct.
criticism, I'm curious your thoughts on this, of the AI boom is that these companies, Google, Facebook, I guess primarily Microsoft, are inappropriately depreciating their software. So they're buying products and they're saying this will last for 10 years. And they're not taking a loss because they're saying it's an investment, but they're not taking the loss up front as they would with research and development, and they depreciate that cost over 10 years. But if AI is really so transformational, maybe these things will not have not be relevant in 2 years. They need to reinvest. So maybe they should depreciate 50% of their costs. So I'm curious your thought on that argument, as well as just your observation that research and development, not capex, is what leads to positive results.
Um, CapEx, you have the issue of how fast do you turn the capital expenditure into new profits. And that can happen fast or slow or not at all. The blended average is that it happens slower than you thought and costs more than the ultimate benefit on average. Now, there will be lots of exceptions. R&D, as you say, is a P&L breakout, and some companies don't break out don't break out R&D. Most of the ones that don't do much R&D, but but I'll give an example. We have a paper on SSRN called Fundamental Growth that looks at uh, companies' growth rate in R&D spending, growth rate in sales, and growth rate in cash flow as a filter to identify which companies are growth stocks. And we find that it works way better than cap weighted growth indexes because the marketplace has this weird illusion that value and growth are two ends of a spectrum. That if it's value, it's anti growth. If it's growth, it's anti value, when nothing could be further from the truth. Relative cheapness is one dimension, relative growth rates is another. And they're correlated, but they're not highly correlated. There's a quadrant, high valuation multiple, sluggish growth, that over the last 60 years would have had 2% per annum poorer returns over a 60-year span than any of the other three quadrants. So if you disaggregate and recognize that growth and value are two sides of the same coin, are not two sides of the same coin, but are two dimensions in a space, you wind up with a much richer understanding of growth. And one of the measures that we use is rate of growth of R&D spending for the companies that do break it out. Um, uh, we also looked at the classic Fama-French investment factor, where growth in book value and growth in assets turn out to be a negative because it means that the company is putting uh, management's interests ahead of shareholder interests. And that's why the investment factor in Fama-French has a negative uh, uh, um, outcome for the companies with the fastest book value growth. And sure enough, it shows up in our work as being a fundamental growth measure that doesn't correlate with future growth.
Why does book value serve management?
Because it means you're plowing back the money that you're profiting from instead of letting the shareholders share in it.
Oh, okay. So not doing buybacks or dividends and that kind of stuff.
Correct.
Yes.
You're tacitly assuming that whatever we can do internally is better for the shareholder than anything that they could come up with. Our roster of available choices for use of the money is limited. Theirs is unlimited, but our choices are better. If you've got growing book value and growing assets mean you are highly profitable. Otherwise, you wouldn't have growing book value or growing assets. And if you're highly profitable and you're greedy about it and saying we're keeping it, uh, that's a negative.
What is the point, Rob, where you get extremely confident of underperformance or even negative performance on a stock when it comes to valuation? So, for example, Nvidia, I just looked it up, trailing valuation 47. I know you like trailing valuations. For a forward price to earnings ratio, I think it is around 30. Maybe a few days ago, slightly above 30. Now it's, I believe, slightly below 30. Obviously, that is what analysts are expecting. It could be higher, it could be lower. But to me, a stock that has been growing its revenue, I'm just looking year over year at 56%, that valuation may be justified. Maybe it could be even undervalued. But you referenced low growth, high valuation stocks, and I just want to talk about the companies like Costco or Wingstop, companies that have a PE ratio of 50 or 60 that are not growing at 56%. Like, what is your level of confidence as a quantitative analyst looking through history that those will underperform? And then also Palantir, it is Palantir is growing high, but the multiple there, I think the earnings ratio on a trailing basis is over 500. And again,
Mm-hmm.
you get that thing where the earnings per share is so close to zero that, okay, maybe the forward ratio is, oh,
Yeah.
it's only 180. But on the sales ratio, you said on a trailing basis 150. Like Palantir, just what is your level of confidence that even everything that the CEO, who he goes on all the podcasts, the VC tech podcasts, everything he says is going to happen, but like the stock, shareholders will not be pleased just because the starting point is so rich.
What does it take for me to be highly confident in a bearish call? That depends on time horizon. If you're talking about confidence that a bet against a company will be profitable on a 1-year basis, I would say the answer to that is never. On a group of stocks, a category of stocks on a 1-year horizon, there are points where I would get moderately confident. On a 5-year horizon, I can get very confident. So we have an online web tool, Asset Allocation Interactive. And if you Google Asset Allocation Interactive and ignore the sponsored sites, ignore the pop-ups, the first link will be to our online tool. And Asset Allocation Interactive estimates forward-looking returns on 130 different asset classes, but it does it in a really simple way. Anything you invest in has a return in the form of what's the yield? How much income are you getting for every $100 you invest? What's the historical growth in income? Not historical performance, but growth in income.
Growth in profits or in dividends?
Basically dividends.
Okay.
And then the question is, the third part of the return is, what's the valuation change? So if you know those three numbers for the future, you know the future return with precision. If you know those three, if you can estimate those three numbers based on the past, then you can get a decent handle on future returns. The change in valuation is mean reverting. The more the valuation has changed in the past, the more likely it is to mean revert in the future. So we assume halfway mean reversion over a 10-year span. That's very patient. So what do we get with growth stocks? Dividend yield, not quite 1%. I think it's 0.7. All right, well, that's earning 70 cents on every $100 you invest is pretty anemic. What's the growth in income on the Russell Growth Index? This century to date, it's 1% per year faster than the growth rate for Russell Value.
So what's Russell growth is 1% higher?
Earnings growth and dividend growth faster. Actually, I take it back. 1% faster on earnings growth, 1% slower on dividend growth than Russell Value. So the entire outperformance of growth relative to value has been driven by the valuation spread widening between the two. Now, that's not true in the last 2 or 3 years, but it's true in the last quarter century. The third component is mean reversion. The Shiller PE ratio for Russell Value is in line with historic norms. For Russell Growth, it's about twice historic norms. So if it's twice historic norms, halfway back to historic norms is going to be about a 3 or 4% per year haircut. So we estimate forward returns for Russell Growth as 0.7 from dividends, plus 4 from growth in earnings, the historic norm, minus 4 for mean reversion, halfway back to historic norms, which gives you a 1% expected return for the next 10 years. Russell Value, you get 2 and change as the yield. You get the same growth rate, 4%. Now you're at 6, and it's a little cheaper than its 25-year average. So bump it up to 7. So we're expecting 1 from growth, 7 from value, and just under 4 for the broad market. I see today as an opportunity-rich environment. The spread in valuations between markets relative to their historic norms is not without precedent, but very, very stretched. And so I look at international value, emerging markets value, certain out of mainstream markets, emerging markets debt, all priced to offer very nice forward-looking 10-year returns. And then the question is, how useful are these forecasts? Go back over the last 50 years and ask the question, this ultra simple methodology, this isn't a data mining exercise. How can we fit the last 50 years of data? This is simply saying this simple methodology, yield plus historical growth, uh, plus halfway mean reversion over the next 10 years, how well would it have forecast returns over the last 50 years? And the shocking answer is that the estimated return is usually within 2% of reality. Meaning that if we're expecting 1 for growth stocks, we're likely to get -1 to +3. Does anyone buy Russell growth expecting +3 or worse? No. And for emerging markets value, you're looking at 10, which means anywhere from 8 to 12. And nobody wants to buy that. Then you come to Russell 2000 value and you get the same sort of return. You get an expected return of between 9 and 10%. 9 or 10 from Russell small cap value versus 1 for Russell large cap growth strikes me as an extraordinary spread. And it's an exact mirror image of the historical spread in returns, as is normal. We're in one of the few industries in the global macroeconomy where people hate a bargain. Why? Because bargains got there by inflicting pain and losses. And the fact that they're a bargain now doesn't make them more appealing because you're licking your wounds.
So I'm looking at the Russell 1000 growth versus the Russell 1000 value. What sticks out to me is just how concentrated the 1000 growth. Nvidia, Microsoft, and Apple are each over 10% in an
Correct.
ETF that tracks that index, whereas in value, the biggest is Berkshire Hathaway at less than 4%, and then JP Morgan at less than 3%.
Mm-hmm.
Why is it that the value large caps in the Russell 1000 is so much less concentrated than the growth large caps?
That's because to reach the top of the large caps, um, uh, you are almost always a big successful business and trading at a lofty multiple. So the companies that drive the concentration in the US stock market today are almost always going to be appearing in the growth portfolio. Now, that's not abnormal. If you look at any time in the last 50 years, Russell growth is more concentrated than Russell value. And the largest stock in Russell growth is bigger as a share of the portfolio than the largest stock in Russell value. So I think it's probably accurate to say that there's not a single time in the last 50 years when that didn't hold true. I haven't checked that, but that's an educated guess. Today is more concentrated than any other time in U.S. capital markets history. Even data from the 19th century doesn't show today's degree of concentration. It really is. Well, you've got 2 companies, each of which is worth more than the entire Russell 2000. You've got 6 companies, each of which is worth more than Russell 2000 growth or Russell 2000 value. That's astounding. A year ago, we introduced an index and an ETF called NIXT, which looked at companies kicked out of indexes. And it was fascinating to me. People did wonder about the capacity of the strategy. And my reaction was the capacity is not huge. It's a lovely, fun strategy. It's a niche strategy. But the total value of any stock that's been kicked out of the S&P or the Russell index is by definition going to be a small cap stock, and by definition is going to be a value stock and a negative momentum stock, big negative momentum. And the result is you're looking at a group of stocks, even though it's 150 stocks, it's a group of stocks with aggregate market cap 1/10 that of Russell 2000 value, which by definition is less than 1/20th as much as any single stock at the top of the S&P.
These are companies that got kicked out of the Russell 2000?
Technically, no. Uh, Technically, we can't use Russell or S&P. So what we do is we take the 500 largest market cap stocks and the 1,000 largest market cap stocks, and any stock that falls more than 10% out of that list is deemed to be a deletion. And there's about a 75% overlap between that and actual Russell and S&P deletions. We hold the stock for 5 years. Why? Because on average, stocks kicked out of the index outperform by 7% in the first year, and then 6%, and then 5%, and then 4%, and then 3%, and then it stops really mattering. So if you hang on to it for 5 years, on average, they win by 28%. Well, that's pretty cool. Now, certainly there's a fair amount of tracking error, and it won't always work. What you have is going back over the last over the last 34 years, stocks kicked out of the indexes beat Russell 2000 value about half of the time. When they underperform, it's by an average of 5%. When they outperform, it's by an average of 18%. So it's a very asymmetric distribution. When deletions come back, when they bounce back big. If you have a 150 stock portfolio that's beating your benchmark by 18% in a single year, that's pretty astounding. So anyway, that's just an illustrative example of how stretched the market is, that a portfolio of 150 stocks out of the Russell 2000 value has an aggregate market cap 1/20th that of NVIDIA or Apple or Microsoft.
And the anecdotal example of that, I think it really speaks to it, is in 2020, ExxonMobil got kicked out and was replaced by Zoom.
Yes.
Since then, obviously ExxonMobil has done way, way better than Zoom. It is really interesting to me that the S&P, as people call it a passive index, you said a 95% passive, 5% active index, has performed so well and has beaten so many active managers, given that it has this property of like buying stocks when they're kind of the most hype in their valuation, and selling stocks when they are crushed, like Exxon was in 2020. So tell me that strategy, buying the absolute dogs that are kicked out of the S&P 500 or kicked out of the 500 biggest stocks or the 1,000 biggest stocks, that has, as you said, the clear advantages of buying low and selling high. Mm-hmm. However, what about the risk of, as you said, buying value traps? And for example, like I think Warner Brothers Discovery has a recently kicked out of the S&P 500. The companies that kicked out of the S&P 500 often have huge challenges. So how do you avoid that risk? Earlier you said having a kind of a momentum filter, or you just say that is a risk, but overall on a diversified strategy, this still works well.
Okay. Thank you for framing the question the way you did. Short answer to your question is it works well regardless. You'd have value traps. Some of them go to zero. More detailed answer is our next index does a quality filter based on profitability, debt equity ratios, debt coverage ratios, and that composite quality measure, we take out the 20% that's the worst quality. And the result is very few value traps. For the RAE strategies, it anchors on fundamental index and has performance similar to fundamental index, but it filters out companies in free fall and companies with lousy quality. The U.S. large strategy has owned over 1,000 different stocks in the last 20 years. Strategy has been live for over 20 years. How many of those 1,000 stocks have gone bust? Zero. Not one. Now, name a value manager with broad diversification, with 100 plus stocks at any given time, with 1,000 different stocks in the last 20 years who never had a bankruptcy. I'm not sure there's a single other example out there. I'm glad you brought up the question of the active passive component of indexing. Typical index fund has 4 or 5% turnover. It feels passive. And because of that turnover, you can view it as 95% passive and 5% active. Because the 5% is new stocks coming into the index and other stocks coming out. Now, the stocks coming in are almost always discretionary additions where the stock didn't have to be added but is added. Maybe it's
I
by
did not know that.
formula.
I did not know that before reading your work to prepare for this. Yeah, that's interesting.
Yeah. So the stocks that are added might be by formula for Russell, or might be by a committee decision for MSCI or S&P. But either way, it's a discretionary choice. It's not forced into the index. Very few are the result of spin-offs where it's sort of an existing company splits, becomes two companies, and they're both in the index. That's a very small minority. The deletions, a lot of them are corporate actions, and about 40% are discretionary, where they are adding Tesla and looking for a company to kick out, and so they look around. I like to joke that S&P committee adds a stock when they're embarrassed it's not already in the index, and deletes a stock when they're embarrassed it's still in the index. I made that joke with an executive of S&P, and he laughed and he said, "Yeah, that's about right." Um, anyway, it's there's nothing inherently wrong with the way this happens, but think about the active side, the 5% turnover. The stocks that are added are stocks that are typically trading at an average of twice the market multiple, trading after a surge of interest, trading at, on average, a 60 or 70% premium to the year ago price relative to the market, 60 or 70 percentage points of outperformance that the index missed, and decided I better get on this train. And the stocks that are dropped on average are half, if they're discretionary deletions. I mean, if it's a takeover and the stock doesn't exist anymore, that's a different story. But if it's a discretionary deletion, then it's usually trading at less than half the market multiple. It's usually after a period of free fall, hence my joke that the committee is embarrassed it's still in the index. If you're Russell and you do it by formula, it's the same thing. You're adding stocks that have soared. You're adding stocks at premium multiples, that where the expectations are great and the reality might or might not be great. And you're deleting stocks that are deeply out of favor, unloved, and dirt cheap. So this is the rotation that takes place. 95% of the portfolio is blissfully passive, doesn't care in the least whether the company's going up, down, or sideways, whether its fundamentals are strong, weak, or whatever. Doesn't care what the valuation multiples are. It's passive. It really just is along for the ride. And the other 5% behaves like Cathie Wood on steroids, buying the frothiest of the growth names and hating and loathing the cheapest of the value names. Again, there's nothing inherently wrong with that, but that does have a cost. And the cost is stocks that are added, about 25% of them are kicked out within 10 years, flip-flops. And about 60% of the discretionary deletions are discretionary deletions that are being kicked out within 10 years. So the flip-flops comprise about 60% of all discretionary deletions if you ignore M&A activity that forces a stock to cease to exist. So that means most of the selling that's done in the cap-weighted indexes is flip-flops, companies that shouldn't have been bought in the first place. We have a research paper. It's going public on the 12th, and it looks at these flip-flops in detail. And what we find is that flip-flop stocks that come in and then go out, on average, outperformed by 7,500 basis points in the year before they're added. Now keep in mind, the indexes didn't catch that because it's before it was added. Underperform by 75% before it's deleted. Now keep in mind, if you're up 75 and down 75, you're not back where you started, you're down over 50%. Ouch. And after they're kicked out, as we already documented in previous research, subsequently you outperform by 5. So these flip-flops, you're not in during the rally, you're in during the cratering, and you're not in during the subsequent modest rebound. Triple whammy. And the cool thing about that is that it's a fixable problem. We developed an idea that we call RACWI, Research Affiliates Cap Weighted Index. We quietly introduced it almost exactly 4 years ago. Quietly because we wanted to develop a track record before, a live track record before sharing it with the marketplace. We knew how it worked in backtest, and we were confident that the backtest wasn't data mined and therefore was pretty reliable. And lo and behold, what we find is that if you just change the paradigm for adding and dropping stocks, if you just change that 5% active component, you can get rid of that performance drag. Now, how do you replace that? Choose to add stocks that are entering the 500 largest businesses, not the 500 largest market cap most valuable stocks. So a company might slowly drift into that list or might soar onto that list because it's an NVIDIA, whatever. But it's going to get on that top 500 businesses list years after it gets on the top 500 market cap list. Now, does that mean we're buying late? Yes. Does it mean we're buying at a higher price? Not necessarily, because it was added when it was frothy. It might not be as frothy anymore. And so the pattern of additions and deletions, you're deleting stocks when their business has eroded enough that they're no longer in the top 500. And does that mean that you're selling after the stock's been in free fall? No, in fact, the deletions on average outperformed modestly in the year before they're dropped. How can that be? Because the business is shrinking. The market already saw the shrinkage and did its damage. And then the business has shrunk enough and we say, okay, let's drop it.
The business performance, revenues, profits, but the fundamental business performance actually has outperformed in the year before it's deleted. So the share price has obviously been underperforming drastically in the market cap, and that's
share price over the years before, not over the year before, not the single year before. It's actually on average has done okay. But the important thing is you're not selling stocks at 50% discount to the market. You're not buying stocks at 100% premium to the market. And that makes a difference. So the result is, going back over the last 34 years, just changing the way you decide what stocks to include in the index. Instead of saying we're going to have the 500 largest market value companies, we say we'll have the 500 largest businesses, and we're going to cap weight it. You have 95% overlap between RACWI US and S&P 500, just 5% active share. And that 5% active share over the last 34 years would have been worth 63 basis points per annum higher return. Over the 3 3/4 years that this strategy has been live, it's been worth 81 basis points per year. How much tracking error? 56 basis points. It's already got a t-statistic of 3. In my personal portfolio, I take that little 5% non-overlap and go long the RACWI's active share relative to S&P and short S&P's active share relative to RACWI, just in my personal portfolio, and I leverage that up. And boy, it's been a fun ride. Anyway, we're publishing that article on the 12th, and concurrently on the 12th, ETF Architect is launching an ETF based on the RACWI US index. And so I am really excited about that. The indexing world has been profoundly boring, the cap-weighted indexing world. You've got the 1,000 S&P 500, the Russell 1000. You've got innovations like, okay, we've got growth and value. Innovations like, okay, we've got sectors. All right, that's all been done decades ago. No innovations in decades on how do you choose what stocks come into or go out of the index. It's always been based on price soars, market cap soars. It's on our radar screen, it gets added. And so just shifting the paradigm by saying we're not going to do that anymore. We're not going to chase fads and dump crashes the instant that the fad is at its frothiest or the crash is at its deepest discount. We're going to just patiently wait till the business becomes big enough to matter or small enough to no longer matter. And that really incredibly simple paradigm shift is worth historically on the order of 60 basis points, and live more like 80.
And how much of that 60 to 80 basis points, or I guess I should say 60 basis points historically, is the negative drag of the S&P active versus the positive drag of this new thing you have? Sorry, the positive performance, yeah.
It depends on your benchmark. Relative to the S&P, it's a positive boost from our methodology. Relative to our methodology, it's a negative drag using S&P's methodology. The simple fact is they're both passive to the same extent. They're both 95% passive and 5% active. The active component in one looks like a mild bias towards growing businesses versus shrinking businesses. And the other, it's wild-eyed, frothy growth versus deeply unloved, deep value. So the 5% active in one case is hyper growth on steroids, and in the other, it's kind of patience, sluggish, mild preference for growing businesses. The difference is just in that little 5% active sleeve, and both strategies have a 5% active sleeve. Actually, it's 4, because the turnover for both S&P and RACWI is 4%.
And does the 95% overlap have identical or very similar market weights, like NVIDIA?
We're cap weighting, so yes. Now,
Okay.
here's another fun nuance. The companies that are big market cap but small businesses, they might be on the S&P and not on RACWI because they're not a big enough business. Palantir's an example.
I was about to say that, yeah.
These companies have big market cap. The companies that are in RACWI and not S&P are predominantly large businesses that aren't large market cap. Collectively, they're small market cap. So the 5% non-overlap consists of 5% companies that we don't own that the S&P owns, and 2% companies that we own and the S&P doesn't. But the ones that we own, we're cap weighting, so they're small cap. All right, they're a small part of the portfolio. What do we do with that little 3% difference? We take the 95% overlap and we weight it up 3%. So that means we're overweight relative to the S&P for NVIDIA, Apple, Microsoft, microscopic extent. If one is 7% in S&P, it's 7.2 in ours. The weights are identical, plus a small smidgen increase in RACWI for those overlap stocks. And the only difference beyond that little 3% boost is that S&P has its own methodology for defining float, and we use the Bloomberg definition. So there are occasional little differences of a few basis points, but basically the overlap stocks, we have exactly the same weight plus 3%, plus or minus differences in the definition of float, which is tiny and cancels. But it's a very cool portfolio. Yes, we overweight the frothy growth names at the top of the list, and then leave out the even frothier growth names that don't make the top 500 in terms of the size of their business.
That's interesting. So from this report, which we'll link when it goes live on September 12th, is the largest companies that are in your RACWI and not in the S&P are Marvell Technology, that's a real company, Cheniere, real company. Flutter Entertainment, real company. It's in gambling. And then the largest stocks in the S&P, but not in RACWI, Palantir, CrowdStrike, DoorDash, and Royal Caribbean. That's interesting. Palantir and CrowdStrike have very rich valuations. Palantir nosebleed levels. Royal Caribbean, I wouldn't have thought that as a growthy, tech darling that's overvalued. Is that, does that speak to another characteristic of a type of stock that's in the S&P but not RACWI?
I'm embarrassed that I don't have the answer to that. I noticed that as we were writing the paper, and I meant to check. Royal Caribbean used to be a Netherlands company, and I did check, and it's now headquartered in Miami Beach. So it may have been excluded because of its previous domicile, foreign domicile. So we do not include foreign domicile companies. S&P rarely includes foreign domicile companies. Russell 1000 frequently includes foreign domicile companies if they're big cap trading in the U.S.
Okay, thank you for that, and that's kind of a statistical thing. Rob, how are you thinking about the differential between valuations within the United States and outside of the world? I mean, in particular, I've seen you talk about how British valuations, UK stock market are quite cheap. Uh, Personally, I think that the Chinese stock market is very, very cheap. What does your statistical analysis say? Just how cheap the rest of the world is to the United States, or how expensive the U.S. stock market is to the rest of the world, and also how predictive is that of performance?
Relative valuation is highly predictive of long-term performance. It's a very weak predictor of short-term performance. This is why being a value investor over the last 15 years has been painful and increasingly lonely. I look at U.S. versus non-U.S., and Shiller P/E ratio in the U.S. is about 38. In developed ex-U.S., it's about 19. So it's a 2-to-1 ratio. Emerging markets is about 16. So emerging markets is at almost a 60% discount. Where were they in 2008? U.S. was at 28, not 38. So we're more richly priced than we were going into the global financial crisis and that market crash. All right, that's a danger zone. Europe was 34 times. It's now 19. Emerging markets were 38 times, very near the dot-com bubble peak for the US of 44 times. Emerging markets overall 38 times, and now they're in the 16 range. So the underperformance of developed ex-US and emerging markets relative to the US has been partly due to earnings and dividend growth in the US being better. It has been a better growth engine, but mostly due to valuation multiples crashing from a premium to US multiples to a deep discount. I view that for the patient investor as an invitation to make as large a bet as you're comfortable, that your 10-year returns will be better elsewhere. The spread between growth and value in the US is also in the values in the cheapest decile in history relative to growth. I think it's about 5th percentile by historic standards. It reached an extreme in the dot-com bubble. It reached a bigger extreme in the value crash after COVID hit, summer of 2020, and it's very nearly that cheap again today. So it's been bottom bouncing since the summer of 2020.
The value to growth differential.
Correct. At some stage, one of two things must happen. Either growth has to continue the recent outsized earnings surge that we've seen in the last 2 to 3 years, which has been abnormal. Like I said, century to date, Russell growth has had 1% per annum faster earnings growth than Russell value. Dividends 1% slower. So either that faster than normal growth over the last 3 years is a precursor of continued material outperformance on the earnings front, or those valuation spreads are likely to come in. And if those valuation spreads come in, that means either a slow fizzle or a bubble pops.
What do you make of cap weighting? We talked about just how concentrated the S&P is, and many other indices are, and that is because the S&P is not, I don't believe, constrained at all, or the constraints are way above what Nvidia is now 8% of the index. But market cap weighted indices have outperformed cap weighted just because it has been the biggest companies that have done so well. So you did not want to cap Nvidia at 2%.
Yeah.
You did not want to cap these companies. Are you a long-term bull on unconstrained cap weighting? Just let ExxonMobil, JP Morgan, or in this case Nvidia, get as big in the S&P as it can just because big companies continue to dominate? Or do you believe in constraining it in an index of no company can get bigger than 3%, 4%, or 5%, or any other limit?
Well, if it was either or, I'd say the unconstrained. I think a more nuanced approach would be to truncate overweights if the underlying fundamentals don't at least partly validate that weight. Now, NVIDIA in fundamental index has about, I think, about 1/4 its market cap weight. Apple has about 80% of its market cap weight.
And the fundamental index is RAFI, something you've been older,
RAFI.
but it's older than the RACWI, which we've been talking about.
So both Schwab and Invesco have fundamental index ETFs and mutual funds that are large and have been very successful. Relative to cap weighted value, for instance, if you take Schwab's FNDF ETF versus iShares IWD value, Russell Value ETF, you find over the last dozen years on the order of 2.5% per annum outperformance with only about 2 to 2.5% tracking error is really absolutely remarkable. So it's a better approach to value, but it's also a different approach to indexing the market because all the stocks are eligible and are included. They're just included at their economic footprint. So you find out what percentage of all publicly traded stocks this company is, NVIDIA, as a percentage of sales of all public companies, as a percentage of profits, as a percentage of book value plus intangibles, as a percentage of dividends plus buybacks, four different measures. How big is it? What's its economic footprint in sales, profits, net worth of the business, and distributions to shareholders? Average those four measures, and you're basically saying we want an index that looks like the macroeconomy, that weights companies according to how big they are. And cap weighting says we want an index that looks like the market and that therefore looks like what the market thinks the future economy is going to look like. Viewed in that context, RAFI is just an alternative approach to indexing. Viewed from a cap weight perspective, it's a value tilted, slightly anti-momentum active strategy. Long way of saying that if you've got a stock that's trading at a large premium to its fundamental economic footprint, I wouldn't be averse to truncating it modestly. We don't do that in RAC. We do simply cap weight. But we select more carefully on the 4% turnover doesn't look like an emerging growth manager on steroids.
And thank you, Rob. So you started talking when we started talking. You said that this market you've been comfortable using the word bubble. Yes. How should people be thinking about allocating capital during a bubble? Because just sitting out or having shorting a bubble can be very painful. You didn't want to be shorting stocks in 1997 or sitting in cash in 1997. Like long term, that probably isn't the right thing to do.
I remember Jeremy Grantham was shorting the S&P in 1997, increasingly shorting it. and had a short position in line with or maybe even bigger than his net worth by 2000. Ultimately, it paid off. But geez, that had to be a painful 3 years. You can't pick the top, and you can't know how big the top is going to be. That's the big danger in shorting a bubble. You don't have to own the bubble, and if you do own the bubble, you can be lightly underweight and just say, okay, I love these companies. They're wonderful. And yeah, they're building a future for us. It's great. Why don't I have 80% weight? I'll participate. And if they crash, I'll be hurt a little less. You could do that. Or you could say, now's a time to put more into value than into growth. Now's a time to put more into non-US than into US. These are all very rational choices. If you're running other people's money, just remember, other people, all of us as individuals, tend to have less downside risk tolerance than we realize and will be angry sooner than we tell you we'll be angry. We won't be as patient as we think we'll be. And so if you're running other people's money, you gently nudge in the direction of what you think will be the right place to be. And my rule of thumb for other people's money is don't ever put somebody in a portfolio where they can't stand 2 years back to back of disappointment. If you do, you've exceeded their risk tolerance, and they'll fire you and they'll reverse the portfolio. So you will have done them damage, not good.
But doesn't that happen sometimes? I mean, 100% in stocks, they were down in 2001, they were down in 2002, right?
Mm-hmm.
So but some people should be in 100% stocks, like, people who are 25 or 30.
Oh, now that's an interesting one. We wrote papers in the mid 2010s about glide path and target date portfolios in which we pointed out that that's exactly wrong.
Really? Okay.
Yeah, the narrative is you want to be 90% stocks if you're young, and 60-40 when you get to middle age, and 40-60 when you're ready to retire. No, it turns out that if you actually reverse that, you wind up retiring. We modeled this using 200 years of data. You wind up retiring with a wealthier retirement on average. Why? Because you have more money to invest when you're older, and therefore the higher returns available in stocks matter more. The higher returns when you're 25 and just getting started don't matter.
But also the drawdowns don't matter as well. So
That's not true.
okay.
If you're 25 and you hit a recession, you're last in, first out. You're going to be an early unemployed. And I remember in the global financial crisis, Fidelity released a report, and I don't remember the numbers on it, but their 401k investors who were under 30, something like 30% of them cashed out, even though near bear market lows, even though they had to pay 15% penalty tax for withdrawing because they needed the money. So when you're young, play it safe. The other reason to play it safe is if you get burned when you're young, you're going to be risk averse for life. And so start cautiously. I'm also of the belief that a young novice investor is probably going to trade like an absolute idiot,
Yeah.
which does not mean don't make individual stock picks. It means mostly do boring index stuff and bond funds, but do dabble in individual stock picks and view your experience as tuition. You're learning. Whoever's on the other side of your trade undoubtedly has way more information than you. And so whatever trades you're making are probably a mistake. But by doing it on a small scale, you're learning, and it's a great way to learn inexpensively.
Rob, you said a lot of contrarian things in this interview. I think the most contrarian moment was what you just said about how you should actually have a higher allocation to stocks when you're older and a lower allocation to stocks when you're younger. at first I'm just like, whoa, there's no way that's true. But I think I'm starting to guess it because you're taking into account the behavioral,
Right.
empirical fact that if someone gets burned, if a 24-year-old gets burned in the stock market, they're not going to be investing in stocks. Whereas the traditional recommendation accounts for probably a close to 100% rational person who is, if they're young and in stocks, they get burned, they're going to keep on allocating to stocks. Whereas you're taking into account the behavioral aspect. That makes sense.
Absolutely, absolutely. The target date community enlisted academic help, laying out a theoretic reason for the classic target date allocations, which these days are 90% stocks for early targets and 60% for late career. It really should be lower on both and should be a different slope. But be that as it may, um, the academic rationale that I describe it as they've enlisted academic help. Academics will write papers that say what you want them to say if you pay them nicely for it. Um, and the academic rationale is when you're young, you have enormous human capital ahead of you. If you're 60, you have much less future human capital at your disposal. And human capital is like a bond. It's your steady income. So you don't want bonds when you're young because your life is a bond. And you do want bonds when you're old because your life is mostly behind you and you don't have much of the bonds left. Um, and that's just wrong. Does a person's pay over the course of their lifetime look like a bond coupon or like a stock dividend?
Stock dividend.
For sure. Meaning
Yeah.
that your start of your life, your
Gross.
human capital looks like an investment in the S&P, if not a leveraged investment. And when you're 60 years old, it still looks like the S&P, but it's smaller. Now, the other just slight nuance is I have no problem at all with the notion of peak equity exposure in your 50s diminishing as you approach 60 and 70, because when you reach retirement, unless you've accumulated lots of um, financial resources, you can't bear the downside of serious losses in those last years. But a decade away from retirement, do you really want to be risk off? How many decades are reward or risk off posture? Not many.
And ultimately, it does depend on the individual. What you're saying is true on average, but there are people who are going to have a very high risk tolerance. They can take an
Mm-hmm.
80% drawdown and still always be, sunshine Charlie. And then there are
Yeah.
people who can't handle it at all. Um, so is it impossible to time bubbles? Like, if you think it's a bubble, how long do bubbles statistically last? And how long do you think this one lasts?
This one has lasted longer than most. And therefore, this one,
When did it become a bubble?
I think it started to resemble a bubble even before the 22 market slump, and started to starkly resemble a bubble in 24. So this one feels to me like a tired old bubble. Um, if I had to time it, I would say uh, I'd be shocked if the froth hadn't deflated fairly significantly within the next 2 years or so. But could it happen? Absolutely. So I'm a long-term investor. I think in terms of 5 and 10 year horizons, and I roll with the 1 and 2 year volatility and just water off a duck's back. But most people aren't that way.
And Rob, so you think the bubble started in 2020, 2021? I actually agree with you. I think the peak froth in my, I mean, what do I know? But in my view was in 2021, you had these IPOs and SPACs and these garbage companies going public. That is something, Rob, that I have not seen so far. I think you're beginning to see it. But what do you make of just the relative lack of IPOs? And like, do you buy the theory that it takes, Wall Street selling a bunch of crappy companies and going public, like we saw in 98, 99, 2000. Not that I was a sentient investor then, but to really prick a bubble.
That certainly helps. One of the things that's very different today from the year 2000 is that Congress has made being a publicly traded company fairly significantly unappealing. So, for about the last 15 years, 20 years, I've been saying I'll never work for a publicly traded business.
Why is that?
The amount of record keeping that's required and the short-termism that's foisted upon you is leads to unacceptable decisions. Research Affiliates is the first business I've started for myself. In the past, I started First Quadrant, TSA Capital Management, always owned by a publicly traded business. And what I found was that I was unshackled and able to do anything I wanted in the way of product innovation, developing new ideas, spending money on R&D until the business got successful enough to matter. As soon as it got successful enough to matter, the parent company cared about my quarterly reports. And as soon as they cared about my quarterly reports, 20% of my time went from managing a business to managing an owner. And that is just, that's the downside of today's hyper-regulated world. So a dearth of IPOs can just in part be a function of, if you've got a successful business, why do you want to do an IPO? Mm-hmm. Why do you want to burst your own bubble? Now, if you're a pets.com and you've just finished selling $5 million of product that cost you $20 million to purchase and $20 million to market, then yeah, you have your own little bubble and you want to go do your IPO and cash out. For what it's worth, it went public for $300 million. It rose in the first 2 weeks to $400 million, and it ceased to exist less than 12 months later. Hilarious story. But in any event, lack of IPOs can be partly a function of lack of interest in doing IPOs and lack of appeal of being a publicly traded business. Privately owned businesses operate with less constraints and less regulatory reporting burden. I mean, we file our SEC reports and FINRA reports and all of that stuff, but it's not as hyper-regulated as it would be if we were publicly traded.
I am sure you're correct that independently owned, founder-led and owned companies have way less short-termism than the median publicly traded company. However, I think they're companies owned by private Wall Street, private equity, that they definitely have reporting requirements and they're trying to juke everything.
Yeah.
And that private markets have grown so much. What do you make of the growth of private markets, and how do you evaluate them, as well as potential claims that they're sitting on some overvaluation and that returns going forward will not be nearly as rosy as the stated returns that have been historically, which have been very good?
Yeah. Well, firstly, the best private equity and the best private debt players are very good at what they do. And there will always be some that perform very well for their clients. That said, the median for both industries will be heavily affected by the availability of good deals. Now, if you're running private equity, if you have 100 private equity managers all looking for good deals, the number of good deals per private equity manager probably is not going to average even one per year. And so you have the problem of too much money chasing too few good deals. The same thing, perhaps even more so on the private debt side. An early mentor in my career was fond of saying, any product that's easy to easy to sell should never be bought. And I think there's truth in that. I would have very little confidence in my ability to choose winning private equity or private debt managers in the looking to the future. It's easy to choose the ones that were great in the past. But the ones that are going to be good in the future, I have no confidence in my ability to make those choices. If you have good reason to believe that your choices will be the best of the best, go for it. If you're buying it just because that's where the returns have been in recent years, don't.
Yeah. And so many large pools of institutional capital have, I'm shocked to learn just like 40%, 50% allocations to private markets. And it's definitely gotten very hot.
Mm-hmm. Yeah.
Well, Rob, thank you so much. People can find out more about your company, Research Affiliates, at researchaffiliates.com, and we will link to that paper about RACWI. I really appreciate you doing this.
Thank you very much, and I'm very excited about ETF Architect launching that RAUS ETF based on our index coming up just in days.
Very nice. Thanks everyone for watching. Remember to subscribe to the Monetary Matters YouTube channel, and please leave a rating and review for Monetary Matters on Apple Podcasts, Spotify, or wherever else you get your podcast.
Thanks for watching. As a reminder, this episode of Monetary Matters is brought to you by SMH and SMHX by VanEck, two complementary or standalone semiconductor ETFs that give investors targeted access to the full spectrum of AI's growth engine, from manufacturing muscle to design dominance. Go to vaneck.com/SMHJack and SMHXJack to learn more. Until next time.
Thank you. Just close this door.